Hi everyone, welcome to this session. This is a session about harnessing distributed ledger technologies, or DLTs, to finance the climate transition. It's a very important topic. My name is Iota Nassr. I work as an economist and policy analyst for the OECD Committee on Financial Markets, where I manage the experts group on finance and digitalization of the committee. And today, I'm going to moderate this very important session, and let me preface this session by explaining why I think it's so important. So we currently have two very strong parallel trends underway in financial markets. The first trend is the increased digitalization of finance, which we saw has accelerated and intensified, particularly during and post the pandemic. DLTs are a big part of this trend of increased digitalization of finance. The second trend is the proliferation of ESG investing, as the entire investor community seeks to achieve long-term risk-adjusted returns and at the same time align with sustainable objectives and climate-related goals. So the purpose of this panel is to look into how these two very important trends converge and what use cases can DLTs bring for green fintech applications, as we call them, but also what are the challenges in the deployment of DLTs for this kind of applications, what are the risks for investors and the markets. So we have today with us an excellent set of panelists. Starting from my right, we have Katherine, who is Executive Director of the Green Digital Finance Alliance. We have Alistair Mark, Director General of the Blockchain and Climate Institute. We have on my left-hand side, Pauline Hanriot, Energy Analyst at the Energy Efficiency Division of the International Energy Agency. We also have Mark Radka, Chief of the Energy and Climate Branch of the United Nations Environment Programme, and Claudia Gagliano, Head of Innovation Products and Technology Unit at ESMA, the European Markets and Securities Authorities. And we also have virtually Ben Yablon, who's founder of Solar Nova. So without further ado, let me start with one of the foundational problems or challenges with the use of DLTs for such green fintech applications. So data by nature is fragmented and is not interoperable. And the OECD CMF work has actually showcased such fragmentation for the ESG investor environment, particularly for the E of ESG. The question then is, can DLTs actually solve this problem of fragmentation and lack of interoperability? And for that, I would like to give the floor to Claudia, who will give us an overview of data gaps and reflect on the potential for DLTs to resolve such issues. Claudia, the floor is yours.
Thank you very much. So first of all, thank you very much for the invitation. I hope you can hear me well. I have some slides. No, it's not me. Okay, let's wait 1 second. Yeah, a bit closer. It doesn't move. Can try to be closer like this. Okay. Okay, here are the slides. Thanks a lot. So thanks again for the invitation. I will discuss in the next few minutes what are the main data gaps we observe in the ESG world and what technology can do to help the ESG market developing. So what we have observed in the last years is, of course, that there is a lot of interest in ESG products. If you think about the ESG funds sector, for instance, we have that 2/3 of investment fund flows in equity funds. What happened? Okay, yeah, they are back. Went to the ESG products. And what is very important is that investors, when are going into ESG investment, are getting what they are looking for. So that if there is an investment in ESG, the investment is really in this sector. And this is very much relevant for the development of the ESG sector itself and, of course, for investor protection reasons. However, what we observe is that there are a lot of data gaps that make it a bit difficult for investors, for market participants, to assess that the ESG investment correspond to they were looking for. And these create really reporting challenges, but also create greenwashing risk, can facilitate greenwashing in the sector. Now, these gaps have narrowed a bit in the last years, but they are still relevant. And here you can see in the slide one chart showing the share of listed EU companies that are disclosing greenhouse gas emission by market capitalization. This is only one example of the different gaps that exist in the sector. What you see that from 2005 to 2021, we have an increase of the number of companies disclosing this information. And this increase has been particularly significant for the very large company, the orange line, and the large company, the green line. But you see that for SMEs in particular, so the bottom line, which is the blue bottom line, the share of companies disclosing this information is really close, basically close to zero. There are a lot of developments from the regulatory perspective, at least in the European Union, that are trying to address this issue, and they will address at least partially this issue. The taxonomy is almost finalized for all the 6 objectives, and this will help giving more clarity on the different definition. The Sustainable Finance Disclosures Regulation, and sorry about the acronyms that we like a lot in the EU regulatory world, so SFDR, Sustainable Finance Disclosure Regulation. This is for financial markets, and this gives a number of recommendations to financial market participants to disclose their sustainable finance exposure. However, for market participants, it's quite difficult to comply at the moment with this regulation, because what is lacking is the information about the company exposure to for instance, to climate change, to climate risk. And that's where the CSRD, so the Corporate Sustainability Disclosure Regulation, comes in. And this is very important because this is Corporate Sustainability Reporting Directive that will replace the Non-Financial Reporting Directive, and that will require standardized, audited sustainability reporting. And this will make, let's say, the life of financial market participants that need to comply with the disclosure requirements much easier. In addition to that, I want to mention the European Single Access Point, ESAP, that will provide a centralized place where to find all the data related to sustainability-related disclosure. Because what is very relevant when we talk about data gaps is that beyond data availability, which is addressed by all these regulations that I mentioned, there are other data-related issues that can be addressed with the technology. We can talk about data accessibility. So data need to be accessible for everyone, for every potential user. And to do that, the centralization of the data is quite important, because centralization can start a kind of virtuous circle, because more people have access to data, more people can give feedback to the data quality and suggestion to additional data to be reported, and this can improve the overall data quality and the overall data accessibility. Another point that we need to consider is data usability. Data usability, and here, for instance, the technology can help with AI, artificial intelligence algos, but also natural language processing methodology that can help extracting information also from text, from text-based information, so not only relying on traditional data, but also on different sources of data. And for this, having more and more machine readability requirement in all the new regulations that are developed is very important, because this gives really the opportunity to have access to the data and to be able to use the data. Another technology that can help is the use of big data platform, that can help in the direction of improving data completeness and data consistency. So really the data quality check that are allowed by AI algos and big data platforms are really very important to improve the quality of the data. So we don't need only data per se, but we need data that are usable. And another technology development that we see in this area that is helping, that could help a lot the transition, is the development of different green fintech projects. Maybe I'm sure we will talk about this also later. We see in the area of the advice, for instance, robo-advisors, the development of different ESG investment platforms that help investors to understand and to identify the ESG investment, as well as fintech that are developing data solutions to facilitate the reporting, and I mentioned earlier how much reporting is important, as well as AI-enabled tools that are very useful to understand what is in the portfolio, for instance, of the funds that where investors are investing in, and these help against the greenwashing risk. If we narrow a bit the scope and we move to blockchain, there are, of course, in the area of blockchain, some promises, but also some challenges. Starting from the potential benefit, the technology itself, which is in open access, give open access to data, and this data could be shared real time and data that do not change. And this could be really an advantage, because this could represent a single repository for ESG data and also for sustainability reporting disclosure. At the same time, there could be, related to the blockchain development, new forms of potentially more inclusive governance, as well as from the perspective of supervisors and regulators, there could be a lot more transparency related to the technology, as well as for the carbon credit sector that will be mentioned by other speakers. There could be also enhanced liquidity, enhanced transparency for the tokenized carbon credit and offset. But of course, there are also challenges. First of all, the technology is still developing, but we see quite a lot of challenges, because sustainability is not the primary focus of blockchain initiatives so far, and we can say that in a number of cases it was quite the opposite, like for many crypto assets. And very importantly, blockchain and crypto assets have become themselves a potential source of data gap. Having been working for years on monitoring crypto assets, as there are sometimes really huge challenges also in having basic measures of crypto asset market. For instance, trading volume. What is the trading volume? It's true that on-chain data are potentially accessible to everyone, with a lot of technological expertise, but putting together on-chain, off-chain, what is the real trading volume, just to give you an example, is really not straightforward. And also there are some issues related to fragmentation, interoperability, that really needs still to be addressed across different blockchain. And I think my time is already over. Just to conclude with the last slide, we need to think what is the direction. We have seen now the merge, so this move from the proof of work to proof of stake by Ethereum, that from the perspective of energy consumption can be encouraging. And at the same time, very importantly, we have the new EU marketing crypto asset regulation, MiCA, which is finalized, and that will be probably published in the official journal in April, in spring next year. And why I'm mentioning this? Because in the final text, we have some disclosure provisions for issuers and providers of crypto asset service providers of crypto asset when it comes to the environmental and climate-related impacts. And we think that increasing the disclosure in this sector is very important, in particular when it comes to the environmental impact. And we need also to continue really to monitor closely, because this sector is developing very quickly, and we need to be able to understand and to assess what are the potential risks or benefits related to the environmental impacts of this technology. And I stop here. Thanks. I hope it was not too long.
Thank you, Claudia. It was very comprehensive. You really covered all the different aspects, and you gave us a very good overview, very helpful as well for the rest of our session. And if I may add on the very important point that you made about disclosure requirements and the provisions that will be coming up in the forthcoming MiCA, this is also increasingly important given the increase in the demand and adoption of crypto assets by institutional and professional investors. And so this is becoming increasingly important for this part of the traditional financial market that cares the most about ESG and climate alignment. Now, one of the things that you touched upon was carbon credit markets and the potential of DLTs for those specific markets. And I would like to ask Alastair to give us his view on the potential use and deployment of DLTs for carbon credit markets. Alastair, please, the floor is yours.
Bonjour, everyone. Good morning, everyone. Thank you for inviting me to come back to OECD again for this excellent forum. So before I share our opinions on this topic, let me just briefly introduce the Blockchain and Climate Institute. And basically the BCI is a think tank that helps governments in the deployment of emerging technologies for climate and sustainability policy actions. So we're an international network of scientific and technological experts with 160 colleagues working very hard around the world at the forefront of innovative efforts. And basically, we structure our work streams according to the UNFCCC technology transfer mechanism, including the capacity building, technology transformation, building up enabling environments for governments, and creating mechanism for deeper technology transfer even to local level. And recently we have just fortunate enough to have the Cambridge University Press publish our second book, Governing Carbon Markets with Distributed Ledger Technology, which is available for online for everyone now. And it's the first book-length discussion mainly for climate negotiators, policymakers, and legislators interested in this issue. This is not academic theory book, so don't worry about that. So anyway, let me just go through some of the main points I'd like to share and respond to the questions of the governance of the carbon market governance, the challenges of carbon market governance at the moment. Basically, we see while we see an array of challenges in the carbon market governance globally. In the interest of time, I would like to focus on three challenges. The first one is definitely lack of governance. Generally, governments tend to suffer from information asymmetries and capacity constraints that limit their abilities to identify and implement the most appropriate interventions, and insufficient technical and administrative capacity, including resources, suitable personnel, particularly in developing country governments, leads to insufficient governance. And there are multiple frameworks and crediting mechanisms, plus the demand side of the international carbon market facing various uncertainties, as some of you have probably seen throughout the carbon market, that's Article 6 negotiation over the past few COP. And In the Article 6.2, for example, for the internationally transferred mitigation outcomes, ITMO, or we call it ITMO, which have been authorized, there's still the risk of those being called back, and their status could be in question if the host country were to fail to meet its own NDC at some point. And also there's another issue like buyer liability, which has an adverse impact on the predictability and the reliability of the carbon credit transfer. So in this situation, in a situation in which many ITMOs have been transferred by a host country, may also be not clear which ITMOs should be retracted. So at the same time, for voluntary carbon market on top of the compliance market, there's actually no governance body at the moment. In the voluntary carbon market, the entities can set the private entities, NGO can set their own criteria for project certification and carbon credit generation. There's no common industry or global standards about it. Yeah, and in the EU, for example, the carbon allowances under the EU emission trading scheme are classified under the MIFID, which stands for the Market in Financial Instrument Directive 2, as financial instruments. And voluntary carbon credits are neither included in this qualification nor assigned a unified definition across the EU. Instead, each member state treats the voluntary carbon credit as its own discretion. In terms of this low-hanging fruit solution that blockchain could bring, I'm sure I don't need to explain too much about what blockchain is. So blockchain actually can deliver at least 5 regulatory functions in carbon market, including uniqueness, validity, consensus, immutability, and authentication of the identity of various carbon market players. And distributed ledger technologies also facilitate decentralization and can operate without the need for middle operators like a central authority. And if it is combined with AI and IoT as well, we can definitely simplify the legal process and enforcement and leads to automation of the regulatory requirement and decision-making process, which is likely to reduce the strains on the current governance system in place in each participating countries. The second challenge is about the unlinked markets. We see the existence of multiple frameworks and crediting mechanism that leads to regulatory uncertainty. There are a lot of difficulties in accounting, auditing, and mutual monitoring of emissions between entities in disconnected global carbon markets. The complex and lengthy process to link markets as seen in the decade-long process to link the Swiss and EU ETS that we've seen before. If we employ distributed ledger technology such as blockchain, we definitely be able to connect individual carbon market, and each market continues to operate autonomously while also participating in the network of markets. And in this regard, we require digital infrastructure to provide a connection between these markets as well as the legal administrative structure that operate and manage overseas the network. In such cases, the network I'm talking about here, the network carbon market can be described as a public but permissioned blockchain, which is a precondition for participation that would be authorization to trade in a participating domestic or regional emission trading system. So finally, it's about double counting of carbon credits. As some of you might be quite familiar with this term if you follow the climate negotiation process in the UN community. There's the multinational nature of modern corporations participating in such a complex and disjointed carbon markets often feature governance gaps and poor oversight that can lead to double counting of emissions, whereby one emissions reduction is recorded and used more than once. So if we are able to deploy blockchain technology here, we'll be able to deliver an immutable and tamper-proof registries that exercise at least 5 essential regulatory functions that I've just mentioned. If we combine it with AI, etc., then we can further improve the Know Your Customer, the KYC process, and the transaction and monitoring that prevent account operating and transfer failures and even security breaches. And the transaction checking and recording could be done in a lot faster, a more low-cost way. So I believe these are the just very brief insights that I would like to share.
Thank you so much, Alistair. If I may follow up with one specific question. So in the absence of connectivity between the individual markets in a network of markets, do you see this problem of double counting of emissions being resolved? Or is this really an indispensable condition?
Yeah, I believe it is. I believe this is an unavoidable situation. Yeah, when you have registries who work in silos, a carbon credit A actually could be recognized as carbon credit A again in different markets. So it actually undermines the environmental integrity of all the carbon credits. Actually, yesterday morning, there's an interesting update from EasyJet, the airlines that probably some of you have taken. They've stopped investing in carbon offsetting projects. Instead, they want to spend more time and energy and capital investing in more fuel-efficient engines or even hydrogen power flight engines to really demonstrate their commitment to sustainability. So I'm not sure whether it's really the start of another new trend towards airlines' practices in decarbonizing their operations.
And in your view, since your book is all about governance, how would you envisage the governance of such a network of individual blockchains for carbon credit markets?
Yeah, basically the networking carbon market is a concept originally introduced by the World Bank. I think that if we put the DLT or blockchain to network all those carbon market, we definitely need the participating countries to sit together to agree on a common set of accounting, monitoring, reporting, and verification approaches in order to get all these carbon credit generated in various projects around the globe well measured, otherwise it won't get managed. Yeah, without good quality carbon credit data, it's garbage in, garbage out.
Thank you so much, Alistair. And perhaps we give now the floor to Ben, who is actually operationalizing this kind of idea of carbon credit markets. And I would like to ask Ben to give us his views on issues of operationalization of this kind of DLT-based carbon markets, and how do you actually address this divergence in carbon assets in the market today? Is Ben still with us virtually?
Can you hear me okay?
Yes, thank you, Ben.
Apologies, I'll try not to yell. I'm a bit crestfallen to not be there in person this year. Really appreciate getting to join virtually. So to jump right into it, first off, really detailed and significant analysis so far. So really amazing to see how far this conversation has come since the OECD first began really looking into distributed ledger and blockchain about 5 years ago. The first blockchain forum in 2018 was focused on a lot of the potential use cases for the tech, and they felt a long way off. So to be sitting with you today virtually, unfortunately, and to have this kind of conversation be real is incredibly exciting. And I think it shows the power of the technology, and particularly the importance that the OECD has played in helping bring a multi-stakeholder approach to these complex and seemingly intractable issues. From my perspective, I've been at this from a primarily financial tech background and a legal background. One of the key challenges, which has been addressed, I think, by each of the preceding speakers, is this notion of a single source of truth. And DLT gives us for the first time, particularly with respect to these carbon assets, the ability to have meaningful price discovery. So all of these issues, I would say, are seemingly interrelated, but they fundamentally probably come back to issues around greenwashing and somewhat of a level of distrust in the fundamental economic viability of these various markets. And as a result, I think that we've missed an opportunity to monetize these assets in a meaningful way. And DLT is very well positioned to help eliminate a great deal of the uncertainty and allow for significant price discovery. I'm going to say a three-letter acronym that I try not to say in mixed company, and that's an NFT. So a non-fungible token is the concept that is, I think, the easiest for people to wrap their minds around today. But when we first began these conversations, the idea of an NFT wasn't something that was batted about. We simply referred to this as tokenization. But tokenization is only part of the story, right? So in terms of crypto assets, pure crypto assets like Bitcoin or Ether, those assets are all effectively fungible. And that's fine for those assets. It is not fine for other tokenized assets, in this case, carbon credits. So by allowing for separate pricing models to come into play in these carbon markets, we will see a great sorting of very valuable carbon offsets and maybe not so valuable carbon offsets. And that mechanism really for the first time is available to us. And I've been laser focused on that from a technology standpoint and a regulatory standpoint for the last year. So I hope that answers the first part of your question, Iota. I would also, I'll keep things brief because I think a lot has actually already been said, and keep things moving. I would like to jump into the pure tech around how these various tech stacks are going to operate. There's been a lot of ink spilled on the amount of energy used by various blockchains, particularly Bitcoin. And I think that that's only part of the question. So when we start discussing ways to minimize the energy usage, we're sacrificing something in so doing. And in this case, that would be the security of the overall network. So there are technological solutions coming online that perhaps have the security of something as large as the Bitcoin network, but that is yet to be fully proven out. We're in a post-merge world with Ethereum. We have yet to truly understand what that means and how stable it's going to be. The signs are positive so far, but there are other stacks that I'm looking at and I'm directly participating in that are not actually considered blockchains, but they do fall under the banner of distributed ledger. So I think it's worth a bit of discussion around how these different technology stacks fit together and the differences between security, centralization, and carbon footprint. One of the most promising technological innovations in the space is known as a directed acyclic graph. And that is something that's been deployed by entities like Hedera. Other crypto assets like Nano are based on these other tech stacks that allow for nearly instantaneous movement of value with, in some cases, a negative carbon impact. So want to put that out there. Happy to discuss it as we open things up to more of a conversation. And I'll stop there.
Thank you, Ben. Very interesting. If I may follow up on a similar question, since we're talking about carbon credit markets, how likely do you think, from a practical standpoint, how likely is it that we actually end up with this kind of network of carbon credit markets that will allow us to avoid double counting, whether it's NFTs or whether it's other kind of nature of those carbon credits? And if we do so, what kind of risks do you see from the operational standpoint in bridging the different networks?
So I think we've had the first few examples of these projects in a distributed ledger context. I'm not a particular fan of any of them at this stage because they fall into some of the same traps that we've seen in other crypto asset conversations, mainly in stable coins. So unfortunately, I struggle to draw a clean line of demarcation between a lot of the currently deployed carbon market platforms that are using distributed ledger and some poorly conceived stablecoin frameworks, because effectively what's being done in some of these projects, I don't want to paint with too broad a brush, but in a lot of these projects, what is effectively happening is you're taking a whole basket of disparate credits, bundling them together, and then issuing your own asset against it. And that's very similar to what's gone on with the problematic stable coins. So to combat that, a different model is needed. And that's where I come into this from the NFT perspective. If you can allow each asset to undergo its own price discovery, I think that you eliminate a great deal of the problems with what's been deployed so far. And we then have a meaningful opportunity to address global markets and incentivize significant capital flows into these kinds of projects. And I just don't see that happening yet with the currently deployed models. I think there are several initiatives that are right on the cusp of launching something that really will answer some of these fundamental problems of price discovery and transparency.
Thank you, Ben. Very interesting viewpoint. Since our discussion has been touching upon data for all the speakers up to now, perhaps we give now the floor to Pauline from the International Energy Agency standpoint to give us the hard data and statistics on blockchain investment, on the needs in electricity grids and distributed energy sources. Pauline, the floor is yours. Thank you.
Sorry. Thanks a lot, Iota. So first of all, here I'm going to discuss blockchain in the energy field. So first of all, why blockchain could make sense in the energy field. I see two main reasons. The first is that electricity is a product that is mostly fungible. 1 kilowatt hour will give you the same service. And it's already traded and built based not on inventories, but on meter reading. So that makes it something relatively easy to transcribe into a blockchain compared to say inventories of luxury bag or food supply. So in this way, the energy field already has an architecture that is compatible with blockchain. There is already decided that you have to trust some sort of meter, and that once the data on your consumption is known, you will not be able to come back and check if the meter was right or not, and you have to admit this data is true. So the question of the oracle problem of blockchain is something the energy field already deals with standard measuring data. So in this way, it's a field that is relatively prepared to architecture like blockchain. That's it's looking from the past. And looking into the future, there's another trend that makes the energy field especially relevant for blockchain. It's a trend toward decentralization, by that I mean that we came in a very caricatural way from a system where there were a few large power plants connected to transmission network and with central operators managing the dispatch almost over the phone. And we're coming now to a world where we have more and more distributed resources. I'm thinking of renewable energy sources that are often smaller plants or even behind consumption point. But also with these renewables, we need more and more flexibility. And one of the many sources of flexibility, especially since with the energy transition, coal and gas are not an option, is demand response by consumers. So we see a trend where we go from managing a few large power plants to multiple small demand response or small production. So a trend toward what is called decentralization. And here, because we go to numbers that are more and more difficult to manage by a single authority, the idea of blockchain comes. So this is not an obvious case, because you might also say that even if the source of production are more and more decentralized, there will still be a need for a centralized authority. There will never be a world when you are allowed to connect to the grid by just drawing a cable and plugging it to the closest point of the grid. So we are more into still a permissioned world. We're not going to a fully distributed blockchain with permissionless, but in a way you can find in the way the power grid and power system are evolving some things that looks like the right place for blockchain. So that could be the theoretical diagnosis. If we look at what is really happening, we found some data about early stage venture capital investment, by which I made seed, Series A and Series B. And we looked at where this investment is going, and that's the graph you see. So the first, and obviously the figures for 22 are not final because 22 is not final. So what we see, first of all, is that although the number of deals is relatively stable, or at least there's no clear trend, the size of deal must be increasing because we see an increase in the total in the total money put investment happening. And if we look at what makes the most of the story, we got carbon offset credit trading. I'm not going to discuss that too much because it has been very well explained by the speakers before me. Another one we see is green mining. And this one is especially, I think it's important. It's not investment in blockchain itself. It's more investment to make sure that mining blockchain and cryptocurrencies is done in a renewable way, but I think it's a topic that the blockchain has to address when we discuss blockchain and distributed ledgers for an environment. We must first discuss the impact. We've seen it with the recent news on Ethereum going proof of stake. So I'm not going to discuss that today, but I think it's something that we should see in this graph. And the last we see as important is the peer-to-peer energy trading. So this idea that people connected to the grid could exchange electricity with their neighbors without going through central markets, but just in a fully decentralized way. So perhaps one of the best known in the energy field is the Brooklyn microgrid, where it's the case neighbors that have solar panels on their rooftop can sell excess supplies through smart contracts. So everything is managed by the blockchain. So that's something that we see happening. We see happening regularly on this graph. It's not just the trend of 1 year. And so that is perhaps something where blockchain could really make a change into the energy system by making a transaction quicker, making sure that even small stakeholder can act into the market, making the things more transparent so that people want to play a role in it. I won't say blockchain is the only technical solution in that. There might be other ways to organize relatively transparent platform to exchange energy. I will not say either that blockchain is enough. I would say that the first start is data. Because you can have a very beautiful blockchain. If you have no data to insert in it, you won't go very far. And in the Brooklyn microgrid and other peer-to-peers, they're obviously all working with at least half-hourly data. That's not the case for most of the consumer around the world. And so before changing the power system into a decentralized way, it will be the question of data. And with this question of data comes the question of the size of the blockchain. Is one thing to have the Brooklyn microgrid or a small community do peer-to-peer exchanges with smart contracts. It would be another to have a large part of the power system working on blockchain. But still, we see that blockchain is a trend that is going in the same direction as other trends we see in the power market. And so I would not conclude that blockchain is the game changer for the energy field, but we definitely see that something is happening. And to succeed in the energy transition, we will need many technologies, and I think blockchain can be part of it.
Thanks so much, Pauline. If we can go back to your slide, I have two very small questions. I find it fascinating that decentralization has so many different forms and shapes. So this is already an excellent point to make. Now, my first question is about what you identified as green mining, and we see that in 2022 it has, until now, completely disappeared. Is this because there is no more new VC investment in crypto mining, given the merge and everything, or is it because of data?
So it's green mining. So it's green mining, so that's not, there is no investment in mining at all, that's only not. Green mining, so by that, what you will see behind these stories is often using renewable to manage data centers, which mean data centers that are sort of flexible. As to why there is none this year, first of all, as I mentioned, the year is not fully done. But yes, from our database, we did not find any. It might be when looking into the database, sometimes there are deals that could belong into two categories, but I don't think it's too much the case. Green mining is relatively straightforward compared to peer-to-peer and over-demand response. So I would say it's simply that the year is not finished.
So we very much look forward to your finalized report about 2022, particularly when it comes to this green mining. The other question I had is about scalability. You talked about the Brooklyn microgrid project. So I guess that scalability remains one of the issues and the challenges in having deployment at massive scale. Does this mean that we will only be seeing like add-on solutions for part of the grid, or how do you see this going forward in the future?
What's sure is that for now we only see things indeed that are sort of add-on as a layer. It's also in place where there is, it might happen more in place where there are huge constraints. For instance, in Brooklyn, if you need a new substation, given the price of the land, the substation is especially expensive, and so you might, flexibility might reach high price. But yes, for now, it's more an add-on, but I would say it's not specific to blockchain. More generally in the energy field, you would discuss distributed flexibility platforms, and again, for now it's an add-on that is starting in place where there is a specific need that goes further than the whole system. Then there's this question, if we try to imagine a world, a power system fully transformed by blockchain, it means a change in the way the central operators operate, because for now, we have, depending on the country, it's called a utility, a TSO, an ISO, but we have someone that is making sure in the end that everything goes well, and definitely centralized. Could imagine a world when this is sort of put into the blockchain, but that would be such a massive change that I don't see that coming just for the sake of blockchain. So it would mean that in another way it failed. But as a distributed part of the system using blockchain for more specific needs, I think it totally makes sense.
Very interesting indeed. Thank you so much, Pauline. And perhaps we move to our next speaker, who's Mark from the United Nations Environment Programme. And we would like to hear from you, Mark, about your digital transformation program and its goals when it comes to data architecture, digital ecosystems, and how all this is informing and transforming our markets. Please, Mark.
Well, thank you very much, Iota. I am not a blockchain expert at all. I work with the UN Environment Programme, where I head the Energy and Climate Branch. So I am best thought of as a use case, and what I will share with you today are some perspectives from the environmental community about how blockchains can help not only carbon markets, but I think more broadly environmentally. And I hope that's acceptable to you experts who are looking for, let's say, the detail, because I don't necessarily have that. We did, a few years ago, as a point though, organize a meeting of blockchain experts and energy experts. It was very interesting because we found out they speak completely different languages, And that led to a lot of interesting interaction during the meeting and afterward about use cases. You know, what do we see about the world from the environmental community, and what does the technology afford? And it was a kind of mutual, an exercise in improving mutual understanding. So I think gatherings like this are quite important. So UNEP is 1 year into a new medium-term strategy that was endorsed by all member governments. That means 196 governments endorsed this strategy, and a 4-year strategy. And it has 3 priorities, all characterized as being planetary crises or planetary environmental crises. The first of these is climate change, the second is the loss of biodiversity, and the third is pollution and its links to human health. And in UNEP, we created a new transversal sub-program called Digital Transformations that cuts across these 3 areas. And we are looking for the ways in which advances in all digital technologies can help the environmental agenda. So a systematic examination of new and emerging technologies and how they can help partners in governments and in the private sector and even consumers act on or take action on the changes that are needed, and to do so in a faster, data-driven, transparent, and accountable manner. So, you know, some of the themes that we've heard today. There are 3 strategic areas in our approach, and they all apply to the energy and climate transition. The first is I would say, more foundational in the context of today's discussion. That is helping build a digital ecosystem of data analytics and indicators that can monitor the state of the global environment in these 3 areas particularly. So in practice, that means establishing digital platforms for the timely and transparent monitoring of environmental change, as well as measuring progress in achieving the goals of multilateral environmental agreements, like the Framework Convention on Climate Change, but there are quite a few of them, and the Sustainable Development Goals. So really foundational work to see how do the actions and the policy changes and the investments that need to be taken to meet these 3 shared environmental goals, or deal with 3 environmental challenges that are common to almost all countries, and how can digital technologies help there. And we do think blockchain can help because of what we've heard, the ability to transform environmental sustainability reporting and assurance and confidence in the information that flows back. So helping both corporations and governments measure better and then make sensible policy decisions and then take action on those. And further down the chain, I would say, enabling consumers and investors to make better informed decisions. 2 examples come to mind. You could use automatic data collection and management of greenhouse gas emissions, realized through smart contracts that are based on access to real-time and trustworthy data, so market confidence in a sense. And the second example is in the area of greenhouse gas accounting via the blockchain, which we think could increase the effectiveness of carbon taxation in those jurisdictions where it's applied. The legitimacy and hence the performance of any tax system in carbon markets, of course, as well, depends on transparent and trustworthy GHG emissions data. And we are working with a group called the Carbon Call, I think led by, I don't want to guess, Microsoft and Google, perhaps, on this. The second area in our strategy is, or in our approach to the strategy, is influencing markets and supply chains and consumer behavior through digital channels. And that means integrating environmental data analytics, sustainability outcomes with digital applications, platforms, and algorithms that underpin markets and influence supply chains. And that they also shape consumer behavior, and all of this with an aim toward driving toward a more circular economy. You know, not a linear economy, but one where there is more, let's say, recycling in a sense, in a very broad sense. And the need here is greater supply chain transparency. I think we've heard elements of that, not necessarily characterized exactly as supply chain transparency, but that's what it would be to us. And the ability to verify product origins and carbon footprints. There's the need to get around the monitoring challenges that prevent more circularity in material flows, if you think about it very broadly, carbon being a material that's flowing. Blockchains can support transactions all across supply chains because of their immutable record of provenance, as we heard. And the potential exists, from our perspective, in full and almost radical transparency and traceability of products from source to store and ultimately back into new products. So the results and consequences would be better informed consumers and given a presumed environmental preference, a greater demand for environmentally preferred products or environmentally friendly products, of which carbon could be one component. The third element in our strategy I won't dwell on, but it's basically digital literacy, innovation, and governance issues. So we've heard a little bit about governance, but there are many countries in the world, and those where a lot of the demand for energy and greenhouse gas emissions will occur in a greater and greater percentage are not around this table, and hence great demands, I think, for improved digital literacy. So not directly relevant to the discussion today, but an important part of our agenda. If I could just pick up on one point that you made, Pauline, I think, and one of the questions put to us was, how did you phrase it? Associated technologies or the parallel technologies. But the world is undergoing we're at the kind of, I would say, end of the beginning of a very radical transformation of the energy system. And it's accelerating, and it will see a world that is more electrified, more decentralized, as you pointed out, and where the lines between producing electricity, consuming electricity are blurred. There's an interesting term, prosumers. We all might be prosumers in the future, both producers and consumers of electricity. Electricity, of course, is unique in that battery technology is getting better, but to date, it's largely been instantaneously provided to meet the demand. And that requires a lot of sophistication, as Pauline pointed out. But if we look to the future, the ability to kind of move electrons around and to pay for that, or to have the exchange of energy for money or something equivalent, is going to become more and more important. And any way that blockchains or related technologies can help in the evolution of the global energy system, I think is going to be absolutely useful if it brings confidence and it brings kind of the real world, real time flexibility that is going to be demanded of the energy system of the future. And a lot of this will occur not in OECD countries, but in the global south, where the demands are increasing. So thank you very much. Initial thoughts from an environmental perspective, perhaps, but thank you.
Thanks, Mark, for giving us the gist of the Digital Transformation Program and its goals from the UN Environment Program. I would like just to follow up very quickly on the issue that you mentioned around digital literacy and all this financial innovation and non-financial innovation. In your view, is this need for digital literacy something that is across the board of both the market, the energy providers, the grid operators, the supervisors, or is it something that you see more urgent in one specific part of the ecosystem for this to work going forward?
To say all of the above, but I think two areas stand out that Pauline mentioned one of them, and that is the regulators, because the electricity system or the energy system writ large is fairly well regulated for sensible reasons. You cannot decide that you'd like to build a new generating asset and go plug it into the grid, as you said, because that would disrupt too many things. So regulators, energy regulators need to understand the technology. And then earlier, one of the speakers made the point, maybe we'll come back to it, but there's this whole parallel universe of the climate change negotiations in Article 6 of the Paris Agreement, and the ability in trading carbon markets that are endorsed in a sense legally in the international realm. And I think there's a real lack of understanding of this technology in climate negotiators. Probably 1 in 100 would sit in this room and have any idea of what people are talking about. And yet they are the ones that are thrashing out the rule book of Article 6 of the Paris Agreement. And you know, how will markets work? There are a lot of concerns about permanence. You know, particularly in the area of land use change, and forestry. You buy carbon credits from, let's say, avoided deforestation in Brazil. Well, what happens if someone goes and cuts the trees? Who's responsible? So there are a lot of environmental integrity questions around here, around this whole area. And I think the blockchain community would be well advised to kind of understand the concerns that climate negotiators and say the broader environmental community have about some of these issues.
That's very interesting, and it's a very good segue to our next presenter, Katherine. So, Katherine, building on what Mark just said, we would like to give you the very tough task of connecting all the dots and giving us your view about how all the things that we touched upon in the first part of our discussion are connected with the wider diplomacy efforts and all the digital green finance initiatives. Thanks, Katherine.
The slides there. Well, while we were waiting for the slides, I am very happy to be back here. It's been a very interesting couple of years since 2018 when we had our first blockchain climate carbon markets discussion. And I wanted to state that I am representing here I'm the new executive director of the Green Digital Finance Alliance, which is a Swiss-based not-for-profit that was launched at the WEF in 2017 by UNEP and Ant Financial. It is a catalyst of next generation green digital finance, and we're building now on 5 years of international collaboration with a global ecosystem of international agencies, philanthropic organizations, and corporate actors. And we co-create. We started largely with global thought leadership with the UN Task Force. We did some really great frameworks on digital green bonds and open tools and frameworks, including landscape readiness assessments that looked at both the financial and the innovation landscape to see what were the gaps and silos in addressing technology and emerging and green finance. And then also we're working on market-led demonstrations across thematic areas. But I'm also coming here from a perspective, from the SDG and climate innovation perspective, and from very practical experience. As a former diplomat turned climate kick innovator, and then for the last 7 years, building out actual pilots and programs and frameworks, ranging from solar, bunker fuel minerals, and food traceability, to the World Bank blockchain carbon market pilot, and also, lastly, the nested climate accounting for the global stocktake, as well as the CAMDA data working group and the UNEP digital transformation codes community. So I'm trying to address, where we started this dialogue and where we've come, and some of the issues that we've been covering. I even had an NFT fundraise with Beeple and raised $6 million for that carbon, nested carbon accounting. So it's interesting because I was reflecting on that from our past discussion. And as we know, we've had 30 years of these international agreements, goals and targets. We've had both COP and the SDGs, which are about national goals and targets. and committing to 100 billion in climate finance by 2020, clean, affordable energy, net zero emissions targets, as well as that first global stocktake that is supposed to happen in 2023 and could cost upwards of 3 billion, and progress is stalled. So in that time frame of this 30 years, we have to remember that technology developments have gone from rotary phones and radar and punch card computing, which I did in high school, to the siloed sectoral tech, to what is often called emerging technology. And in 2015, it was a turning point, not only for COP and Paris and the new global sustainability goals, it was also the cusp of this emerging technology and what the WEF would call that fourth industrial revolution, and of course the blockchain revolution. This idea of revolution is something that really caught hold, but I counter to say this was also based on these estimates based on World Bank data that the market opportunity for these emerging techs was often, this was the slide that was also often showed in pitches for fundraising for these startups and whatnot that were working in emerging tech. And theoretically, the financing is there, but how were we to do it? Technology was supposed to help solve all of this. And if we think about how far we've come in terms of blockchain, we've moved from Bitcoin to other cryptocurrencies, including new platforms and coins, into tokenization of other assets, whether it's diamond identities, agricultural commodities, solar energy, etc. And then we had this little detour into ICOs, if you remember, where it was vision-based for fundraising, based on white papers with no real intrinsic value. And then we had massive regulatory clampdowns, basically, and a high failure rate of those ICOs. And this conflation of cryptocurrencies and blockchain for SDGs and climate. And I think that was something we all had to wade through. And the underlying blockchain technologies have also evolved to support a wide range of applications. We've had new layers of applications that can be built on blockchain systems to allow users to access, use, and contribute to the chain. And for the climate space, the real potential to use blockchain were around those misaligned incentives, transparency, efficiency, etc. And what it came down to is that trust in the blockchain and these solutions was fundamentally built on verified data. And so we needed this tech integration to start happening and scaling up, including geographic information systems, satellites, sensors, biometrics, etc., all for that monitoring, reporting, and verification to get the good data into the systems. And then basically, it requires an integration of technology. It requires trusted data. It also requires collaboration and relies on networks of oracles and that capacity to enable blockchains to absorb and interact. But this hasn't happened to the extent it could have. And now we've gone from that world into this new world of NFTs, DAOs, and Web3 with new risks and issues to address. And if you think back to where we were back in 2016, I'd say, the early use cases started emerging for 2017 were very much about sectors and what we could do with the SDGs. I think I saw this wheel at every presentation I went to. And I think also, we had these, very early use cases around the Everledger, the Tuna Tracker, and even the UN Food Program. And we were supposed to, leverage these and integrate these and scale these up. And, there was even one headline that said it was going to save the UN. And after doing these landscape frameworks with GDFA and some of the other pilots I've been working on, I realized that actually, as was said here, those of us coming from the climate and SDG space are often speaking a very different language from those in the fintech space and also from those from the green finance space. So this is sort of my goal with GDFA, is to bring these silos together. We're starting to see the silos merge. And here, I wanted to give you some idea of the perspective I'm coming from. These are the actual pilots and frameworks that I've directly led or worked on. And it's a range because it's not only ethics frameworks and data frameworks talking about that need for the architecture, for the infrastructure, and the harmonization of data, but it also addressing that carbon footprint of the technologies themselves. And also new elements of the business models themselves, such as the big tech companies that are out there, the impacts that cannot be measured in terms of not just their energy use, but on the SDGs, and especially in developing economies, and how any of this is supposed to integrate with legacy infrastructure. It's not just about literacy, it's about that legacy infrastructure. How can we connect these models and use them truly in a developing context as well? And so we've gone from building out the frameworks and the toolbox for digital green bonds, for example, to actually implementing a pilot with the Bank of International Settlement. And what I would say there, as just an example of the former perspective of how we would use digital green bonds, on the next slide, these are the principles that we outlined back in 2019 when I was with the GDFA as CIO. And here we worked with HSB to look at the inefficiencies of the green bond issuance perspective. And what we found was there are a couple of avenues that could be pursued. And these were laid out, and again, this has been used globally by different organizations on how we can actually start building out digital green bonds for financing of SDG and climate. But it could be, the aggregation of smaller assets, fractionalization of large assets to consumers, and the capacity for direct individual investments into community projects, as an example. But why weren't these built out? Well, I think a big part of it, too, is that these are still very much focusing on your typical green infrastructure, energy, transport, etc. So with the BIS, what I did was say, okay, well, what would it look like if we started integrating these with those legacy and community-based projects to truly try to hit some of those other SDGs in this capacity? And so we gave an example of how we could aggregate community-level projects that are already generating data, that are already tapped in through not smartphones, but SMS type data that can be actually elevated and brought into a blockchain capacity for this type of framework. So again, I remind us how far we've come in terms of the data, in terms of the blockchain, and in terms of the policy and regulatory frameworks, and think about how we can actually start having these integrated solutions, how we can cover that end-to-end type of capacity. And as one example, I'll show one of the organizations advised, Blockchain Triangle. This is where the models start to hit the ground, where we have the climate and ESG compliance merging with the portfolio of assets and the data that are being aggregated or accumulated for those into that auditing and KPI compliance, and then into the actual management of assets. So this is just one example of some of the integrated blockchain integrated use cases that are starting to finally emerge. But it's taking some core things. It's taking that addressing of the data issue. It's taking actual funding of these initiatives and collaboration of the organizations with the startups who are still struggling. There's 350 of us in the Climate Change Coalition, and each of them is largely struggling with the fundraise for their siloed solution, if you will. But we're committed to working together, and the Green Digital Finance Alliance will be focusing on not only merging that, but also addressing some of the impacts that we're seeing in the emerging landscape as well. And I'll leave with that because here are some resources that I can also provide, having experience firsthand in DAO governance using Ulstrom's theory for the Algorand build. We've just sort of prepared a paper on that. And then also for NFTs, looking not only on the carbon footprint with the Hyperledger study here, but also on 3 challenges that are starting to emerge in this new era of blockchain and emergent technology. And I call it the three Gs: geography, gender, and groups of stakeholders. And there are emerging divides and a more narrowing view on climate and carbon that are starting to emerge of this. They're starting to reject the carbon markets or create their own models around those. So we are on the cusp of a new era of blockchain and integrated solutions. But some of the legacy work, pre-blockchain and blockchain work, is actually now not under threat, but definitely being sidelined. So I'll just stop there.
Thanks, Katherine. Very, very rich presentation indeed. And one question that came to my mind has to do with the potential reasons for all the different use cases we've seen for many years now and that have not really produced any killer application of the sorts for the energy or environmental part of the discussion. And the reason I'm saying this is that we see the massive amounts of funding that are coming into the DLT space, and the vast majority of them go to financial applications. This could be perhaps due to the fact that this is the easiest arena where you can actually monetize your investment. Do you think that this is one of the problems that has to do with the lack of scalability of the use cases in your space, or what are other additional reasons for this lack of funding?
Yeah, I've actually thought it and written about this a lot and analyzed it with the Climate Change Coalition. Some of the barriers, and I think it again is a different ecosystem, right? So in the financial space, the startups and innovations grow within the financial community and that ecosystem. And that doesn't connect very well. And Switzerland is a good example where we have, the Sustainable FinTech Alliance, but you have groups in Zurich that are largely on the crypto and asset side and fintech space. And then in the Geneva and Lausanne area, you have more of the emerging tech for SDGs and climate space. And they're pitching towards very different types of funds there. And the SDG and climate space using DLT, it's largely in the impact funding. The business models are divergent as well. We have hybrid models, for-profit, not-for-profit. And I think there, it's also because they are not literate enough. I don't mean it as a criticism, but there's a literacy gap between the two ecosystems. We need to bring them together, I think, more.
That's a very important point for us to reflect as well going forward. So this has been very informational in the sense that we have heard of so many different use cases that can make the difference. However, adoption levels of any of these use cases are still very, very low. So I would like to open the floor to all of our speakers to hear your perspectives on the reasons why adoption of these very, very important use cases with very beneficial potential impact has not really achieved the level we would have hoped. And perhaps I start with Claudia and we move.
Thanks for the question, which is very relevant indeed, because we see a number of use cases, but as you said, there is no clear application. I think what you mentioned, Katherine, is a very important one. The fact that climate people and financial people are speaking different languages. From the financial market perspective, which is the sector I follow more closely, there are, in Europe, there are some issues that are, of course, related to that are common to the fintech space, so related to which regulation could apply. We see that the market needs are there. So we see use cases. So in principle, from the economic perspective, this should develop. But of course, there are some obstacles and challenges. What can we do? Because the question is then, from the regulatory perspective, what can be done to further develop these use cases? One initiative that we have at EU level is the so-called European Forum of Innovation, the European Forum of Innovation Facilitators, which was launched in 2019 and which brings together all the national regulators across the financial sectors, so securities market, banking, insurance sectors, and in particular, when it comes to this regulator, is the innovation hubs. So these are part of the regulators that try really to work with the fintech companies, in particular also now in the green space, to try to understand and to try to, on one hand, to help them to develop, and on the other hand, to help them to also to, of course, comply with the regulation. And I think this kind of private-public interaction is very important to further develop these use cases. So this could be one suggestion from my side. A second one is related to disclosure. I mentioned it during my presentation earlier. I think it's important to increase the disclosure, because disclosure, data availability, increase trust in these use cases, and we know how much trust is important for financial markets. So I think these are the points I wanted to make.
Thanks, Claudia. Mark?
I'll go back to a point I made earlier, that I think in the issue of carbon markets, that there is it's a hypothesis, okay, but a lack of alignment between the voluntary carbon markets that have existed so far and those falling under Article 6 of the Paris Agreement, which I'll read it out for you because it's an impressively long title, but it's formally the voluntary cooperation in the implementation of nationally determined contributions to allow for higher ambition in their mitigation and adaptation actions and to promote sustainable development and environmental integrity. So emissions trading, in its short version, that would be recognized under the rules of, that were worked out in Paris, or agreed broadly in Paris and have been worked out. So Article 6, the rule book, was only agreed in Glasgow, and there's still a lot of ambiguity. I think when it comes to those last parts in particular, what is in the environmental integrity? I mentioned that earlier, but environmental integrity is maybe the flip side of confidence, that what you're buying actually is going to, in a lasting way, in which you can have confidence, have the attributions that you're paying for. And for voluntary, for both these, I think it's not a technical issue. I have greater faith in the ability of the technical people to sort out the blockchain issues than I do in the negotiators to come up with something that would be, let's say, agreeable when it comes to issues of environmental integrity. There's built into there's a conundrum, in a sense, built into the whole architecture of Paris, I think, and that is that it upended the approach by saying every country should say what it could do and make some kind of commitment to reducing greenhouse gas emissions. And if you can trade away something that you could do, are you really trying hard enough? Or is your commitment real? There's the language of increasing ambition, and conditional and unconditional nationally determined contributions. And if you say to a country that could do something more but doesn't because it's trading it to another country in terms of emissions, that kind of undermines the whole thesis of the Paris Agreement and in the architecture. So I think there's some deeper conundrums built into the architecture that I would guess influence confidence in markets and don't provide the clarity that you'd really need to move forward. And Katherine, maybe I'm just making this up as no, but tell me what's the view? I'd be interested in, when we get to you, the view from the financial side. Yeah, well, both of you, but I don't want to preempt the chairs.
Perhaps we hear from Pauline and then we move to Katherine and Alistair.
So yeah, on my view, in the terms of electricity markets, so going a bit further from this question of carbon offsetting, I would say one big topic, I already mentioned it, is that decentralization itself is happening slowly, and I would say one big hindrance is data availability. Obviously, especially in Europe and the US, but even also in emerging economies, smart meters are being rolled out or are already rolled out, but having the data is not enough. it's not the technology itself, but if you have a lot of data stuck into the utility IT and not available to other people, it makes it difficult, for instance, to do peer-to-peer if metadata is not available, to sell flexibility services if grid data is not available. So I think one of the big topic is data availability, and with it the question of data sensitivities, because obviously not all data is here to be open. Customers do not like their data to be available to too many people. Business do not like their data to be too open either. And so that's a topic on which we need to find the right balance between respecting these valid concerns and ensuring that the data that can be made of use, including into a blockchain, but more generally to help this decentralized movement, is made available.
I think that's a really good point. I can give a concrete example of how we've had to pivot on that. For example, we have an EU project across 9 cities focused on digital green mortgages. And of course, when the proposals were met, they went with a bunch of assumptions about data availability. And so we've had to pivot into how we're harvesting that data in order to build out the solution. But you know, the wonderful part of that is that we've now been able to create an open tool and platform that hopefully can be used across other sectors or other use cases going forward. But it really has to juggle between you know, the data privacy, data accessibility, company information, individual information, and we found a solution for that. It'll be published soon, but it's more limiting than we'd hoped. I also wanted to talk about, you were talking about carbon markets and whatnot, and another reflection I've had is this, you know, the more we dig into Paris, the voluntary and the, I mean, the entire spectrum of carbon markets, you know, there's growing skepticism on that, on the legacy offset system, basically. And this is actually in what EasyJet has done, as well as others, by saying, oh, well, you know, we can't trust the carbon markets, so we're not going to do that anymore. It's a bit of a cop-out because, pun intended, because what it means is that the projects that are robust, that are producing really good results, as well as the data, are now going to be sidelined. And the new models around DAOs and DLTs are opening up, I think, what is an even much more narrow lens on what is financeable from that innovation perspective. So what we're seeing is, and if you think about the demographics of those participating DAOs and DLTs, you know, the average person is, you know, white male under 35 within that spectrum, so, and very tech savvy. And so that perspective is very much, I want to see, you know, this clear, concise data. And what that means is that, you know, if in terms of SDGs, only a handful out of the full spectrum of indicators are actually robust enough to gather data on. So what that means is that our solution space is becoming more and more narrow. So that's just one side of this that I think we could address going forward.
Alistair, would you like to add on that?
Yes, I think the fundamental issues here in the information and data gap lies in the overly bureaucratic structure of many large financial institutions. I'm not going to name which entity. Yeah, actually, a lot of developing country governments say it's excruciatingly painful to go through the process of approving one climate project. They may take a few years to approve one project, but while they're seeing the sea level around the coastline rising every day. So particularly the impact of some very local community scale projects have been overlooked. meaning those projects with a budget below $1 million usually, they have not been given any opportunity to present the project concept, to present the impact, and also present to the investors why it's worth to invest or fund these local, yes, the most impactful sustainable projects in the communities. So I believe that if we are to close the data information gap, we should stop concentrating only on those commercial scale projects. We need to take a look at the very localized leveled project with a relatively small budget. But I think the introduction of these emerging technologies could help significantly reduce the transaction costs and make this bankable.
Very important point, and goes back to the funding question that we were discussing with Katherine right before. If we still have Ben on the line, if he wanted to also give us his view on why do we still not see adoption levels growing?
Definitely. I'm still here. Can you hear me okay?
We can hear you, Ben. Thank you.
Can you hear me? Great. I think that Claudia really hit on a significantly important part of what's slowed things down, which is regulation. So when we're talking about combining innovative financial tech with something as novel and potentially controversial as climate solutions, things get slowed down in a hurry. So a piece of regulation that I think is important to peel apart here are also the politics of how the regulations are being constructed and the various camps that are lobbying one way or the other. And a vastly important part of what this technology brings is the ability to create a single source of truth, so to speak. So the more broadly deployed this can be, so that disparate viewpoints can participate in the harnessing of the various data sources, the faster this is going to accelerate. In terms of regulation, we've seen things like sandbox licenses in the EU and in the UK. The US is contemplating the same. I think that there's a lot of promise to those, but they also have the unintended consequence of putting some very promising projects into a much more limited field. So conversations like these at this level are, I think, probably the most important ones we can have in terms of reaching some consensus on what the technology stack looks like and how to start adding disparate data sources into it, so that regardless of your particular lens, you're looking at the same data sets and you're arguing facts rather than emotion. So money will flow when there's some semblance of certainty. So from a regulatory perspective, the best thing we can do is provide certainty to the financial interests. And money doesn't necessarily care what's right or wrong, and they're not looking at the spirit of the Paris Agreement. What they're looking at is there a margin to be made, and if so, how? So, with a bit of a clinical eye toward these things, utilizing these technology stacks, I think, opens it up to significant flows of capital, and smoothing the way for that is the regulator's job, while also preserving the spirit of the good work that's been done so far.
Thanks, Ben, and it's an interesting point. We have a question from the audience that relates to that, so perhaps you would like to take this one, as you're also hands-on in the entrepreneurial space. The question is, what's the success rate of these energy blockchain-related smart apps? And also, what is the percentage of these startups making significant use of artificial intelligence and other emerging technologies combined with DLTs? Ben, would you like to give us your view, and then perhaps anyone else from the speakers?
This sounds like a Katherine question, honestly. I know of several initiatives that are using machine learning to get deeper insights. In terms of monetizing those insights, we're still early days. And I'm not sure who put the slide up before with the investment flows into DLT projects and green mining, et cetera. A lot of that has slowed down dramatically, unfortunately, and hopefully as we're coming out of COVID and these lockdowns and the rest, we'll see that accelerate again. But in terms of really successfully deployed projects, nothing on a broad scale. There have been significant attempts to do this. I think I alluded to them in my opening, that are effectively packaging up carbon assets and issuing what is effectively a stable coin against them, which I think is a recipe for disaster. But Katherine, perhaps you're better suited to talk about current initiatives that are making headway.
I think you've summarized it quite well, actually. You know, if I'm looking at the Climate Change Coalition, it has 350 members. I'd say about a quarter of those are working in this field, and none of them have really hit that specific threshold of scaling up, maybe one or two working on sort of a more DAO approach. And I think there are two elements to what we're talking about here. We're talking about, you know, the data and the applications for financing for the projects, but then we actually need to speak about the financing of these startups themselves. And that is where I think a big problem actually exists, because the type of financing available for these solutions are either through procurement, you know, any collaborative programs with international agencies, for example, or governments, is usually through a very old-fashioned procurement approach. Which expects plug-and-play readiness. So that's one barrier. Another barrier is, you know, pop-up regulations that suddenly swoop in and make it impossible to build out, which happened actually with the Brooklyn project initially. And then I think the other is the way that funding for those startups and these projects actually has to happen, which is focused on that venture capital Silicon Valley style, which again, is vision-based and built on hype and scalability. I think we need to lose that term scalability, because as others have said, there are very impactful projects out there that may not scale, but we can amplify impact by supporting them and integrating them in a way. Touching on some other things. Pauline looks perplexed.
That's very, very interesting. And on the second part of the question that we received from the audience, and by the way, I will open the floor for questions from the room right after this, so please prepare yourselves. The second part of the question was about the use of other emerging technologies, such as artificial intelligence. And perhaps I could ask Mark, given that, Mark, you raised the use of DLTs in supply chains, for example, and there I could think of not just the use of artificial intelligence, but also Internet of Things. Would you like to elaborate a bit on that particular aspect?
You hit the ones, Pauline mentioned smart meters, the Internet of Things, you know, more sophisticated devices that allow for instantaneous, or near to instantaneous demand response, because you, let's say, as a homeowner, are happy to have your dishwasher turn on at 2 in the morning if it means that the electricity that you would use in the afternoon can be sold to your neighbor because they want to do something. So all of the kit that would go into that, you can imagine what it would involve, both on the hardware and software side. So a lot of things there, and that's I think why both of us were trying to make the point that it's not only the blockchain. The blockchain or DLTs might be what you have to instill confidence in the trades, but there's a lot of measurement that needs to be done, and a lot of, let's say, aggregation of the preferences of a lot of people and the optimization to determine where electrons should flow at what time. And, you know, maybe one other part of that is storage technologies. You know, the battery that you have in your home or in your car that's plugged in as part of the, you know, the sort of concentric circles of a new energy ecosystem, but one that is, in most cases, still connected to the grid because very few people would want to live in this environment, completely off-grid. So there are multiple layers of complexity of the technology and the software that holds it together.
Thank you, Mark. Anyone else wants to add something on this?
I can only agree with what Mark said, that indeed it's about many technologies. On artificial intelligence especially, there is a lot to be done based on energy data. We came from a world where roughly energy data was at best 2 metering data in consumption and transmission level assets. Now we have individual consumer that can have data to hourly, half hourly. DSOs have more availability to know about data of the network. So when data flows, obviously, artificial intelligence is not far. We can imagine many possibilities in terms first of forecast. You can forecasting renewable, forecasting demand is extremely important to balancing the grid. In terms of understanding what happened on the grid, on dimensioning the grid as needed, there are many things that the power system has been used to do with complex model and big error margins that could be improved and make the system more efficient. So again, this world around decentralization is not only about blockchain. In fact, at the IEA, we have a whole project on that called Trident for digitalized demand-driven network, on which we look at many aspects. There's market design. We touched a bit on it, but again, if you do not have the right incentives, people are not coming. There's people. We mentioned a bit about digital skills, but trust is very important. So yeah, it's many topics interconnected, and blockchain is only a part of it. And for things to go larger, all topics must progress together.
Could I add one more point? Yeah, and just to sound slightly more pessimistic, if it isn't already, the normal, let's say, evolutionary path of innovation would be let 1,000 things happen, entrepreneurialism, and you'd come up with 8 different ways and 7 different technologies, and let the market decide which one is victorious after a period of 20, 30 years of winnowing out the best, maybe not the best, but the most agile. But we don't have the time to do that. So it implies a much more coordinated approach from the beginning, with all the complexity of who understands the regulatory part, who understands the electricity regulatory part, the financial part, the financial technology part. We got to get all these people in a room and figure out, what is one good approach, I think, rather than hope that in 30 years the market will figure out which one is the winner.
I couldn't agree more. This isn't a beta versus VHS wait and see. This is, what we're seeing are some startups actually starting to amalgamate and integrate all of these issues, as we saw with Blockchain Triangle and EverCity, that are trying to promote a very robust approach. But there has to be an opening, right? And they're stuck in that startup pitch and award era, and they've been there for 5 years. So what it takes is some larger organization, investor, bank, to actually make a start and say, okay, we are going to collaborate. It shouldn't be a direct investment. It shouldn't be a direct purchase. This has to be about building out some of those open technologies, open data platforms, et cetera. But trust is a big part of that. And just in terms of where even the spaces where collaboration happens, so you mentioned Carbon Call. And here we have Microsoft, Bloomberg, and a few of the others who have come together to create this Carbon Call. The problem is they already created it. 5 years ago, we created CAMDA, and they were the originators of that. So what's happening is someone else in their organization is saying, oh, not aware of that, and starting the same initiative again with a slight twist on it. And this type of element happens, this type of approach happens a lot within the large organizations and corporates, because even within their systems, it's quite siloed. So I just also put a call out to those in organizations and corporates is to have it look internally as well as externally to what's happening outside of your sector or your business division, shall we say.
Alistair, did you want to come in on that?
Yes. So actually, we have been talking about how blockchain could be a trust machine. If I just borrowed the term from the Economist back in 2015. However, what we may have missed, I'm not talking about this panel, I mean the entire blockchain community may have missed, is why should we trust blockchain? So actually, it reminds us of the first question from the audience that says, "Oh, how many blockchain energy startups have been successful?" I've read some very pessimistic data from one of the big four companies. It concludes that over 90% of blockchain or fintech startup actually disappear in 2 to 3 years' time, for many reasons. Of course, one of the main reasons is again lack of trust on blockchain. So yeah, and then many current private blockchain systems do not fully distribute trust because they still contain single points of compromise, where any single failure of any participant can compromise integrity, confidentiality, and privacy of everyone reliant on the blockchain, which looks pretty ironic. And in reality, which is quite a sad reality, is that a chain of block may be hacked or forced to perform certain operation if a majority of users or if a consensus threshold is in the community decides to violate the pre-established rules. And actually, at the same time, the governments and regulators, according to our lots of interactions with the governmental stakeholders over the last few years, one of the most common observations, or actually even strong opinion from those governmental stakeholders, including legislators, policymakers, regulators, are that they don't know what their new roles will be in a blockchain or DLT-based applications era. Yeah, and if we want to talk about a data gap, of course, once we sort out the technical or actual data gap, we need to sort out the regulation gap. That is how we're going to regulate the data. Yeah, and the data are borderless, and we still do not have industry-wide data standard. That's why we're trying to work it out on ISO level to develop specific standards for different industries. At the same time, governments needs a lot of capacity building in understanding the new role on regulate even new actors. In the traditional financial services regulations that governs our economy over the past 200 years, normally it's just traditional financial institution, i.e. banks, that are heavily regulated by the government. However, if we go for a big data-centric economy, which will happen anyway, whether you like it or not, and then regulators and legislators, policymakers have to deliberate very seriously what kind of data should be regulated, what are the formats and granularity of data they should regulate, and also the new roles of regulators. Instead of badgering the banks or the bankers most of the times, perhaps it's worth for us to think about whether the existing financial services regulation, including financial instruments related rules, should be extended to cover programmers, coders, etc. So I think that's my sharing to these questions.
Thanks, Alistair. These are very provocative thoughts. Of course, they relate to wider issues around DLTs beyond the energy area. And of course, if we had all those answers, we wouldn't be here in the first place in this policy forum. We have less than 10 minutes left, and I would like to open the floor for questions by the audience. Yes, please. Please introduce yourself as well.
Philippe Thévaux from the company SIGPA in Switzerland. I would like to rebound on what Pauline said about green mining and Claudia about the shift of Ethereum on proof of stake, to talk about the consumption of these blockchains and to give some numbers and to illustrate what these numbers means. And if you think of one Bitcoin transaction, this is the equivalent of 1,000 kilowatt hours. And to illustrate what it means, if you have a heater of 1,000 watts, or a heater that you put in your room, you leave it go for 40 days, 24/7 for one single transaction. So this is a lot of energy. If you go to Ethereum, this is 1/5 of that, so it would be 8 days, and the new proof of stake, 10,000 times less. So it's still 10 minutes of this heater for one Ethereum new proof of stake transaction. So this is still a lot. And if you compare that to a credit card transaction, this would be 1/3 of a second of this heater of 1,000 watts. And these numbers are coming from the Estonian central banks, and the Bitcoin it was also published by the IMF. And if you think there are solutions which can consume with blockchain much less, and the Estonian blockchain, or the blockchain that Estonia is using, this is 1/3 of a millisecond of this heater. Okay, so this means it's 10 billion less than a Bitcoin transaction. So there are solutions where blockchain can consume very few energy. And now going to green mining, I'm always puzzled when I see articles from mainly Bitcoin miners saying, hey, we are using green energy for the equivalent of the consumption of Netherlands or Switzerland or Argentina. All this energy, and they said, oh, but this is green energy, or this is energy lost by power plants which cannot be used. So first, all this green energy could be used by the community, by us, and if it's lost, one can produce hydrogen, for instance, by electrolysis of water, and this hydrogen can be used later. So to claim that, hey, blockchain mining is green and it's not a problem of sustainability, to my point of view, this is totally wrong. And I think we should keep that in mind when we have this type of discussion.
Thank you very much. And actually, the environmental impact of digital assets and crypto is something we at the OECD Committee on Financial Markets will be discussing next week. So it's a very timely intervention. Let me give the floor to our speakers if they want to respond to that particular one, and then open the floor again.
Just to say that I fully agree with you, and that we use the term green mining because that's what it's called, but indeed I couldn't agree more that it's a topic that is going to be massive. We see it starting with Ethereum, but it's far from finished, and there cannot be a huge blockchain scale-up if we have not solved that early on.
I would respond as well. Not to put too fine a point on it, but I think you're ignoring the rest of the infrastructure around traditional banking that allows for that credit card transaction to happen in the first place. So while you may be correct that it is an infinitesimally small amount of power for the credit card transaction itself, you are not taking into account the significant impact of the rest of the traditional financial system that allows that transaction to happen in the first place. I think that's an important point to highlight if you're going to make bold statements and cast aspersions against an entire novel technology stack. The point of the power that's being consumed in these nascent blockchain systems specifically disintermediates the need for an enormous, complex, clunky, poorly regulated traditional financial sector, and as a response to the endemic corruption that we've watched in these markets over the last several decades, culminating with the GFC in 2008, which was effectively the impetus for Satoshi's white paper to talk about a better way to move value from point A to point B. So I do applaud that you're pointing out that there are better ways to do this, and that Bitcoin is probably the V1 of this, but I think to compare it to a single credit card transaction is disingenuous at best. I'll leave it at that.
I would like to add to this, and actually we do have, one of our studies does address the financial costs, the costs of energy and SDGs around the banking industry. I also think it behooves us to consistently address the conflation of cryptocurrencies and blockchain, and especially blockchain for climate and SDG solutions that are going to be supporting or are supporting the financial sector and investment into green investments. And most of these are using something other than proof of work. So we are talking about apples and orange orchards. You know, it's very, very different species. I do think we need to address Bitcoin mining and green mining, but I think it really is important that as a community, we address a more, that next stage of dialogue around the energy efficiency of blockchain, because the other element of this is that blockchain for climate and SDG solutions are also addressing the lack of infrastructure, specifically in developing countries, where instead of, you know, large energy infrastructure or even digital infrastructure, banking infrastructure, we're able to go in and create community-based that hopefully we can connect and amplify.
Yeah, so the title of this session is Harnessing Emerging Tech to Finance the Climate Transition. And I think your statement is spot on. I mean, there's still a lot of coal-fired power plants, even in Europe, and given the energy crisis caused by the war in the Ukraine, delays in retirement of plants and so on. So we're going to keep putting carbon into the atmosphere at a rate that is entirely incompatible with what the best science says. And if you want to extend it further, there's still 700 million people, thereabouts, in the world that do not have access to electricity. So to be using large amounts, whether it's keeping the hypothetical space heater going or to not provide it to people who could benefit in a fundamental development way, I think is not correct.
Please, Professor.
Okay, can I add one comment for that discussion question on the energy consumption? So I'm a professor at Georgia University, and I'm holding an annual workshop for the coordination of decentralized finance. And one of the main topic is to giving that good evaluation criteria on the energy consumption, how to measure that the impact of energy consumption, something like that, because that current situation for this topic is some that bad discussion or debate, but so the role of academia is providing some fair and neutral evaluation criteria to make this kind of discussion healthy. And we are now calling for the papers for the next year's this workshop. And I would like to recommend that post some academic papers to have the discussion. Anyway, so if you are interested in that, I would like to invite you to the discussion at the workshop. Anyway, so I hope that academia could help that discussion.
Thank you, Sinish. And if I may add, based on a literature review that we have done, there is huge divergence in the measurement of the environmental impact. So we do need at some point to have robust data to be able to have then the debate about whether and how it compares to other types of transaction. Very, very quick last point.
Hello everyone, my name is Sebastian Cochinescu. I'm the CEO and founder of Tailpath, a company that is doing supply chain traceability. We've been working since 2018 with a lot of actors in the supply chain space, including NATO, and that answers the trustworthiness of startups in this space. I have a question for all of you maybe, but before that I just want to add something that maybe you have missed in your question, that blockchain is actually promising on solving the decentralization and trust and transparency that the old banking system is not. So maybe it's of course orange and apple. So the question is, we are on the brink of environmental disaster, and there isn't enough data to measure the impact of the Ukraine war on our environment. And is there any kind of blockchain initiative or authority that is actually thinking about how to implement emerging tech in order to solve this very, very stringent problem that we all may have, especially in Europe? Thank you.
Thank you. Who wants to take this? Very quickly, because we are running over time.
I think just a general comment is the EU definitely is putting together some innovation programs and rather urgent innovation calls for the situation based on energy, food, etc., as well as reconstruction once the war stops. So I think there is a lens on that, but I think we have to hope for the conclusion soon in order to start implementing.
Thanks, Katherine. And we have overrun, so let me just give 1 minute final comments. It's very, very difficult to summarize what we have discussed because there has been so much in this discussion, very rich discussion, very different parts of the whole debate that needs to be further discussed as well. We have significant opportunities with the use of DLTs for green fintech, given trustworthiness, automation, immutability, transparency, but we also have challenges. We've talked about legacy infrastructure, about complexity, about funding issues, incentives, literacy and skills, and data has been at the core of the discussion today, both at the opportunity side, in terms of data management that needs to be enhanced through DLTs, but also in terms of the challenges. Data on its own has challenges related to its management, privacy, quality. We have this garbage in, garbage out discussion. And we've also talked about silos and breaking those silos, both within the market initiatives and also in terms of private and public interaction. So I'd like to finish with an optimistic note and say that the exact objective of this blockchain policy forum at the OECD is to actually encourage this kind of public and private interaction. I think we've achieved that to a large extent today, and we do look forward to continuing this kind of cooperation in the future. And thank you very much, and please join me in thanking our awesome speakers. Thank you.